Hi, this is Spencer Leu, and today I'm going to answer the question, what is a mutual fund? And basically, a mutual fund is just an investment vehicle where people all over the world can invest in it. So you have these people all over the world, and what they can do is they pool all their money together. So everyone invests different amounts of money, and then together they have more purchasing power to go out and buy more investments. In order to illustrate this example further, let's say you wanted to buy these 5 companies: Amazon, Starbucks, Apple, Google, and Berkshire Hathaway Class B shares. Well, in order to do that, just one share of each, and ignoring commissions, you would have to pay about $1,250. Now compare that with the Vanguard S&P 500 fund, so their 500 index fund. That's trading at about $111 per share, and that includes 503 stocks, and there's about $105 billion in this. So thousands and thousands of people all over the world have pooled their money together, so there's 105 billion, so they can go out and buy these 503 stocks, and for the price of $111 per share, you or I could buy one share and have a portion of that allocated among these 503 stocks, versus buying these 5 on your own. You would spend $1,250, and you would only own one share of each of these, even though they're all very fine companies. So that's a better example of the scale you can create and the advantage of being able to buy into a mutual fund and have access to a lot more diversification for a lower amount of money. So there are a lot of different types of mutual funds. I'm just going to go over 2 very broad categories, and that's actively managed mutual funds and passively managed mutual funds. Now, actively managed mutual funds attempt to beat the market by actively managing. So they buy and sell in order to try and outperform their benchmark, which is usually some kind of an index. And in terms of passively managed funds, they just match the market. And so they're just trying to get the market return. A lot of people wonder about this, and you would think that there's a lot of smart people out there with advanced degrees and a lot of knowledge and all kinds of trading systems, so you would think that active management would be pretty good. Unfortunately, they're not, and there are some great managers out there, but believe it or not, passive management beats active management 60 to 80% or more of the time. And so passive wins 60 to 80% of the time, and the reason for this really comes down to fees. And active managers charge anywhere from 1 to 3%, sometimes even more, per year in fees, whereas that fund I showed you earlier, the Vanguard S&P 500, charges a mere 0.17%. So if you just look at that alone, the active manager is behind by 1 to 3% every single year before they've even done anything, and if they can't beat the index by at least that much, well, they're going to lose. And that's why this guy, Warren Buffett, said this quote: "A very low-cost index is going to beat a majority of the amateur-managed money or professionally managed money." And that just comes down to the fee difference being so much less than what they're charging. So if you ever decide to buy a mutual fund, take a look at the fees and make sure that you're not paying too much, because that's one of the strong determinants of how well that fund's going to perform over time. Thanks for watching, and if you have a moment, please read these important disclosures. I'm Spencer Leu, the Finance Guy.